Hey everyone, welcome back to Corporate Decoder. Today, Cantaloupe Incorporated just filed a Form 8K, and I am seeing a huge shift in control that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. Essentially, the company has been bought out in a big merger, and this filing details the aftermath, including leadership changes and the stock being delisted. Cantaloupe Incorporated, a company you might know by its ticker symbol CTL.P, has officially completed a major transaction. They were acquired through a merger, meaning a larger entity has taken over. This happens all the time. It is how many companies grow or how founders realize the value of their work. In this case, the deal closed on May 8, 2026, which they refer to as the closing date. The deal itself was structured as a merger. Cantaloupe, the company we are talking about, merged with a subsidiary of a company called 365 Retail Markets, LLC. After the merger, Cantaloupe becomes a part of this larger group, no longer an independent publicly traded company in the same way. This is a pretty standard way for acquisitions to happen, often to streamline operations and combine resources. So what does this mean for shareholders? Well, the filing tells us that on the effective date of the merger, every share of Cantaloupe's common stock was cancelled and converted into the right to receive $11.2 in cash per share. This is called the merger consideration. So if you own shares, you got cash for them, and the company's stock is no longer trading on the public market. This is a common outcome in buyouts, providing a cash exit for investors. It is not just common stockholders who are affected. People who held stock options, which are essentially the right to buy company stock at a certain price, also saw their options dealt with. For options that were in the money, meaning the stock price was already higher than the option's exercise price, they were cashed out. The cash received was the difference between the merger price and the option's exercise price, per share. Of the money options where the exercise price was higher than the merger price were essentially cancelled with no payout. This is a typical way to handle options during an acquisition to make sure everyone holding value gets compensated. And this brings us to a very significant consequence of this merger. The stock is being delisted. Cantaloupe officially notified the Nasdaq Stock Exchange that the merger had been completed. They asked Nasdaq to stop trading their common stock, the CTL.P ticker, and to remove it from the exchange. This is a direct result of the company no longer being an independent publicly traded entity. They also plan to file paperwork to deregister the stock and suspend their reporting obligations with the CC. So for anyone looking for CTL.P on the market, you will no longer find it. This is a bit like when a company gets bought out by a competitor or goes private. This also means there has been a big change in control. As of the merger's completion, Cantaloupe Incorporated is now completely owned by its parent company, which is part of the 365 Retail Markets Group. This signifies a complete shift in who controls the company and its future direction. With this change in ownership and control, it is no surprise that there were significant leadership changes. The entire board of directors that was in place before the merger resigned. This is very common in acquisitions, as the new owners typically want to install their own leadership team who are aligned with their vision and strategy, and who stepped in. Several new individuals were appointed as directors of the surviving corporation. Joseph Hessling and Brittany Westerman were also appointed as officers, which suggests they are taking on key operational roles within the newly integrated company. Joseph Hessling in particular is listed as Chief Executive Officer, President, and Treasurer, so he is clearly in charge now. This filing primarily serves to document the completion of this merger. The key agreement governing this entire transaction was the Agreement and Plan of Merger, dated back in June of 2025. This document laid out all the terms and conditions for how Cantaloupe would be acquired. The fact that they are referencing exhibits from previous filings shows the progression of this deal. Looking at the bigger picture here, Cantaloupe's story as an independent public company has ended. They were acquired for $11.2 in cash per share, which is a clean exit for shareholders. The delisting from Nasdaq is a natural consequence, and the leadership changes confirm the new ownership's control. For investors, this means the opportunity to invest in Cantaloupe Inc. through the CTL.P ticker is gone. The value is now locked in as cash. The real story going forward will be how 365 Retail Markets integrates Cantaloupe into its broader operations, and what synergies they can achieve from this acquisition. The risk for former shareholders is effectively zero now, as they have received their cash. The opportunity for the acquiring company is to leverage Cantaloupe's technology and customer base. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.